We are 100% confident every time we make the investment that it's going to be a big company. We are wrong a lot of the time. For most forms of investing, the mistakes are the investments you make where you lose money, right? In our world, it's the investments you don't make.
He made his first fortune by co-founding companies such as Netscape and Opsware. But Marc Andreessen made his name by launching Andreessen Horowitz, the powerhouse Silicon Valley venture capital firm.
We sort of thought it was time to go back to the well, if you will, and basically build a firm that was actually built by founders who sort of understood the process more deeply.
In 2009, Marc and partner Ben Horowitz started their firm with just $300 million. Fast forward to today, it's a top firm with $18 billion in assets under management.
Certainly at the time of their founding, they could lay the claim of, hey, we've built multiple hugely important companies in the past, and we understand not just what it takes to build it, but the actual angst and the plight of the entrepreneur. And that's what attracted a lot of entrepreneurs to ask them to invest.
Pick a big tech name, and chances are Andreessen Horowitz has invested in it. Twitter, Facebook, Airbnb, Coinbase, Affirm, and the list goes on.
There's plenty of very smart people in Silicon Valley, and he's among the very, very few that just on a different level of intellectual capacity, and he is almost giddily optimistic. He's one of these people that you go to talk to about your problems and come out thinking like, wow, like actually I have it so great.
Marc may be optimistic, but he also knows he can't win every time.
We're trying to do the moonshots. Every once in a while, we're going to have rockets blow up in the launch pad.
Well, let's suppose an entrepreneur says, I've read about Andreessen Horowitz and I've read about Marc Andreessen. I'd like them to back my company. How do they get you to back their company? Do they call you up? They knock on the door? They send you an email? What's the best way for somebody to contact you?
So it's a people business, right? It's a very deep personal people connection business. Like a venture capital investment is the closest thing to a marriage that's not a marriage, right? Because it's a 10 or 15 or 20 year relationship. And so you're really trying hard, and I think this applies in both directions. You're really trying hard to figure out exactly who these people are. Are they the kind of people, are we the kind of people they'll want to be in partnership with for a decade, and vice versa? Typically that starts with a warm introduction. It starts with a way to kind of establish a personal connection, kind of between people where you have people vouching for each other. And then there's a process that follows that.
Well, suppose somebody is a terrific entrepreneur on paper. He or she looks great, but they've really never done this before. They seem to have good education. They seem to have the drive. What's the likelihood that you would back somebody who's never done a deal before?
So if they've never founded a company before, and if they just have a plan, it's very unlikely that they raise sort of called top-end venture capital. However, once in a while, you get somebody who's not done it before, but they've already built the product, right? And so the classic example of this would be Facebook. Mark Zuckerberg had already built Facebook at Harvard, right, by the time he started a company. I was an example of this. I had already built the Mosaic browser by the time I started Netscape. And so a first-time founder who has a product, the Google's another example. The Google guys had built the Google search engine at Stanford. And so if you've already built the product, then you have a calling card to be able to raise money for a venture because you already have something that's real. And so the best thing to do as a first-time founder is actually build a product. Now there's a chicken and egg thing there, which is you might need the money to build the product, and that's where people get stuck.
Okay, let's suppose somebody comes to you and he or she is well addressed. They've come to you from a recommendation by somebody that's good, and they've actually built a product.
Right.
When you look at their deal, do you say, we need to make 10 times our money, 20 times our money, 30 times our money to go forward? How do you assess what kind of profitability you want in order to decide how much you're going to put in and when you're going to do it?
Yeah, so we do some quantitative modeling, especially later stage, but the big question is, could you view a path by which this could be a big, important, independent franchise company for a very long time to come? Like, is this kind of the kernel of something that could grow into being something very important and very large? And if you think that's the case, then kind of the math falls out of that, right? Because almost every time that happens, you end up making a lot of money. So that's really the question. And I would really drill into this concept. We focus a lot on this concept of importance. Like, does this matter? Like this product in the life of its users or customers, like, is it really going to be fundamental? Is it going to matter? Is everybody in whatever market they're in going to need this product? Are people going to find it inconceivable to live without this product? If we have that, then it's very easy to build the spreadsheet. If we don't have that, and it's just basically like, oh, we think Microsoft will buy this company in 2 years or something, then we would not do that deal.
So let's suppose a proposal comes in and you see the fingerprints of Benchmark on it, right, or the fingerprints of Sequoia or another firm, Accel. Do you say, look, you've been turned down by somebody else, we're not interested, or they have to come to you first for you even to consider it?
So I would say there's not necessarily. So there's a general sense of heat, right? So there's a general sense. The way I would describe it basically is each top-end venture firm has its own bar. So it has its own set of criteria for kind of whether it thinks a deal should be done or not. And then the top-tier venture firms as a group have kind of a collective bar, which is kind of, is a top-tier venture firm going to fund this company or not? And it's actually easier to answer that second question than it is the first question. Like after you've been in the business for a while, you tend to have a sense of like, okay, this is going to get funded by a top-end venture capital firm or it's not. If it is going to get funded by a top-end venture capital firm, and if my firm doesn't think it's a good idea, you do wonder, like, who's right? Because the other firms are quite smart. And so this is one of the regular discussions that we have, which is like, okay, if another one of these top-end firms is interested in it, that might be a very positive, substantive signal. If the other top-end firms have looked at it and all passed, that might be a substantive negative signal. That said, some of the best deals in history have been passed on by a very large number of people. One of the classic examples, Uber was passed on by a very large number of venture capital firms. Uber was actually available to be invested in on this site called AngelList, where literally anybody with a checkbook can invest. And so every once in a while you get these outliers, and it's fundamentally a game of outliers. Like the money is made on the aberrations. And so I would say you want to be generally open-minded and humble about your conclusions about what all these different signals mean.
So it used to be the case that venture capitalists, let's say the Silicon Valley ones, would look at something called a Series A. What is a Series A investment?
Yeah, so Series A typically means first institutional money. And so it's sort of like the first step towards sort of being a serious business with sort of a serious lead investor, with a serious board of directors, with a serious amount of money, where basically like there's a real commitment being made around to everybody, by everybody around the table that they're going to really devote like a lot of time and effort to making this thing work. Okay, so when a typical firm like yours does a Series A round, you expect to do a Series B, and then a Series C, and then typically you go public maybe after Series C. Is that generally the way it used to work? Well, so the joke is that the goal of every Silicon Valley startup is to get all the way to Series Z, and then every once in a while an accident happens and they go public. That's a joke. Okay. Our goal whenever we back these companies is we want these companies to become long-lived, enduring, independent, standalone institutions. That usually results in them going public at some point. Sometimes they go public after 2 rounds of financing or 3 rounds of financing. Sometimes these days they'll actually stay private for longer and they'll raise 5 or 6 or 7 rounds of private financing. One of the things, the returns have gotten bigger, the wins have gotten bigger. A lot of what's happening is the markets have gotten bigger, right? And so you have this gigantic addressable market for these companies. Now you've got 5 billion people on the planet now with smartphones, right, that are networked together. And so you get one of these companies that has mass appeal. They can get really big. It takes a long time to get that big. It takes a lot of money to get that big. But they have a lot of running room. I mean, we have tech companies now that are worth more than $1 trillion, right? Which was inconceivable when I started in the industry. It was just like an impossible thing to visualize. And so some of these companies just end up raising a lot more money than the historical norms would suggest, and they stay private for longer, and then later on they go public. Why do some people not want to go public? So the public market is a complex and it can be a very hostile environment. Over time, I think it's fair to say the public market has gotten shorter and shorter term in nature. The marginal investor in the public market is very interested in short-term performance. And the number of investors in the public market that really want to invest for a 10 or 20-year period is not that big. And so you can end up with basically this very tightly compressed time frame as a public company where people are really on you about what you're doing for them kind of this quarter or this year. And so some of these more aggressive entrepreneurs that have a 10 or 20-year vision just kind of think they basically want more flexibility in how they build their business. It's possible there's another cyclical boom and bust cycle. Our plan for that cycle would basically be to just keep going.
The world of venture capital has blown up in 2021. There's never been another year like it. In the first 6 months, startup investment was $292 billion. According to CB Insights, that's just $10 billion short of the capital deployed in all of last year, which holds the current record. The U.S. has accounted for almost half of that investment. And no surprise, at the top of the charts, Silicon Valley was still the dominant startup market. But a number of other locations in the U.S. also set records: Los Angeles, Chicago, Austin, Seattle, Denver, and Dallas. And there were some familiar names among the leading deal makers. Tiger Global Management was by far the most active investor. It completed an average of more than 1 deal per business day. Tiger was followed by Andreessen Horowitz and Sequoia Capital China. All that investing has led to a whole new herd of unicorns, startups valued at a minimum of $1 billion. In the first 6 months of the year, 250 companies had joined the Crunchbase Unicorn Board. That's compared to 161 unicorns for all of 2020.
So the venture capital world has been booming. I've never seen anything like this. Is this because people who are venture capitalists are smarter than they used to be? Or because of COVID, everybody is just putting money in the venture things? Why is it so much incredible profits that are being realized by venture capitalists now?
Well, two possibilities. One possibility is we've gotten carried away again. So we've gotten ahead of ourselves again, the same way we did in the late 90s. And things are just are too hot. And that's a possibility. The other possibility is our society is going through a real technological transformation. And it was already going through a transformation before COVID, and I think there's a good argument that COVID has accelerated that transformation. A lot of digital businesses have really accelerated through COVID. And it feels like the world is going to change in some pretty fundamental ways coming out of COVID. And so in that case, you have these new tech companies basically driving this change and realizing the benefits.
Do you worry that because the economy might soften at some point if interest rates are raised, or just because of the business cycle, the wonderful world of venture capital will slow down a bit? And is that a worry for you?
So it's a cyclical business for sure. It has a history of boom-bust cycles, basically just like any other sector of the economy. That said, I guess I would say we do not have a great track record in our industry of predicting these cycles. And I think most of how we either perform or fail to perform is micro, not macro, which is to say it's based on the success or failure of individual companies. And if you just look at the history of venture capital and startups, many of the best companies have been formed during the hot periods, but also many of the companies have been formed during the cold periods, right? And there are pros and cons to those periods. And so, look, it's possible there's another cyclical boom and bust cycle. Our plan for that cycle would basically be to just keep going, keep working with our existing companies, help them through it, keep investing in new companies all the way through, and basically bet on these sort of micro-level, fundamental technological and economic changes that continue to happen.
It seems as if there are no losses anymore. In the old days, the venture capitalists would say maybe they'd make money on 10% of their deals and they'd lose money on 90%, or that's roughly how people might have looked at it. Now you seem to make money on everything. Does anything ever fail anymore?
I can confirm that is not the case. We made a commitment. This is true. We made a commitment to our investors when we first raised our fund. I said, look, we're trying to get to the moon. We're trying to do the moon shots. Now every once in a while we're going to have rockets blow up in the launch pad and put a big crater on the ground. And so I am pleased to say we do both of those. The statistical kind of layout of top-end venture capital, if you look at like the 50-year history of it, it's actually about a 50-50 success rate. And this is for kind of top decile venture capital, so kind of where you want to be. But it's basically 50% of the companies make money, 50% of the companies lose money. And then, of course, you need the 50% of the companies that make money to make more money than the ones who lose money. And that's the general statistical breakdown.
But it used to be the case if a venture capitalist did a very successful deal, the venture capitalist might make 4, 10, 15 times its money, her money, his money. Now you seem to make 500 times your money in some cases. So, for example, a deal that your firm did, Coinbase, seems to be one of the most successful venture deals of all time. Was that obvious to you when you made the initial investment?
No, these are not. Well, so we are 100% confident every time we make the investment that it's going to be a big company. We are wrong a lot of the time. These companies are very contingent. We like to say there's a lot of path dependence in the system. Right? There's a lot of twists and turns along the way. Look, a huge part of it is the competence and capabilities of the founders, and then ultimately the CEO of the company. And of course, they deserve 99% of the credit when it works out.
Now, historically, venture capitalists used to price deals at, hoping they get a good rate of return. But a firm like SoftBank has come in with enormous amounts of money and paid higher prices than I think even you would pay or other venture capitalists. Has that helped the business, hurt the business, or is it too early to say?
Yeah, so I'm a market fundamentalist. I have great respect for anybody who's fielding money, where they're taking responsibility for the results. And I don't like to prejudge. I think SoftBank has made some actually very good investments. I would say sometimes that amount of money is very helpful to a company, which is it really helps them kind of bootstrap and get big and scale. Sometimes too much money is very damaging for a company, right? And you can really kind of screw up a company. And I think that's also happening.
So what about Silicon Valley versus other parts of the United States? It seems as if all the big deals are coming out of Silicon Valley. Coinbase, I mentioned, Snowflake, Palantir. These are very successful IPOs that were based out of Silicon Valley firms where they put the initial money in. What about Austin, Boston, New York City? Are they able to catch up with you, or Silicon Valley so far ahead that nobody can catch up?
Yeah, so I think this is a real pre-COVID, post-COVID thing that's happening right now. So pre-COVID, Silicon Valley had a very powerful lock, in particular on the talent. I think COVID, in the post-COVID world, that looks like it's changing pretty dramatically. because we've all gotten just so much more used to this whole idea of remote work and distributed companies. And so now you see a lot more motion activity happening outside the Valley. And by the way, not just in other cities, right? So it's possible that there's a new Silicon Valley in Austin or Miami or whatever. It's also possible Silicon Valley, we like to say, just moves to the cloud, right? It's also possible these companies kind of shift to running online. And maybe they run without a central location. So our company Coinbase, as an example, just went public without a headquarters address. Right, they literally declare they took the headquarters address out of their S1 when they went public to make the point that it's now a virtual company, not primarily a physically instantiated company.
So let's talk about the rest of the world for a moment. What about China and India? Are they great potential rivals of Silicon Valley, or they're not really going to be able to compete with what you do?
Yeah, no, and I think they're doing very well. You know, China's been very impressive for the last 20 years or so. They've done very well. You know, like anybody, they have their own challenges. Like, you know, they don't have a perfect system either. So they have their own issues. India has a whole bunch of companies that are doing really well or scaling. I would say both of those countries have very vibrant ecosystems with a lot of very talented people.
Do you invest there?
We don't invest as much there. This is another pre-COVID, post-COVID thing. We historically viewed venture capital as sort of a craft business where you're very hands-on with people who you get to know very well and you partner with for a very long time. And so in the past, we were very worried about trying to do that kind of remotely. But again, like in this new world, we have to revisit that assumption because maybe remote is the default. And I think that's one of the big open questions for how this whole industry is going to work.
Now, one area that your firm has specialized in, though you've done many different areas, but is cryptocurrencies. Many people think that cryptocurrencies are not a real thing and not a great asset category, but you are a big investor in Coinbase, among other things. But I remember coming out here a couple years ago, you told me you were going to look at blockchain and things related to that, and you obviously have done that. What is it about cryptocurrencies that you think makes it an enduring investment proposition?
Yeah, so cryptocurrency is one of these things. It's a little bit like the parable of the blind man and the elephant, which is like people touch it from different sides and people get kind of, I think, distracted and carried away and get kind of energized on these different topics. We view it as fundamentally it's a technological transformation. So there's a fundamental technological breakthrough that has actually happened, and it's an area of computer science called distributed consensus. So it's the ability for a lot of basically people and software on the internet to be able to form trust relationships in an untrusted environment. Money is one application of being able to have distributed consensus, but it's only one of those applications. There are many other applications, many other things that people are going to be able to do with this technology. And many of the smartest people in computer science are going into this field, and they're pushing it forward at a really rapid rate. So to us, it looks like it's just the 8th or 9th fundamental architecture change, breakthrough, technological transformation happening in the tech industry. And we take it very seriously because of that.
So your view is not whether Bitcoin is good or not, or worth X or Y, it's just that the whole technology that underlying Bitcoin is going to transform the world?
These are new kinds of computers. This is the thing that gets very subtle. These are new kinds of, Bitcoin is an internet computer. Bitcoin is an internet computer that's spread out across hundreds of thousands of physical computers all over the world. It's a transaction processing system that runs without any sort of central location. You know, it's like a giant distributed mainframe, and it processes transactions. And out of that transaction processing comes the ability to exchange money. Out of that process comes this token, the Bitcoin token, the coin, that's a representation of value of the underlying system. But it's a complete transaction processing system. Like it's a new kind of financial system.
When people invent something, usually, even if they're shy, they might say, well, I did something nice. How come the inventor of Bitcoin hasn't surfaced publicly?
So this is one of the most amazing things I've ever seen in my life, which is, I would go a step further. Most people, when they invent something this profoundly breakthrough, they actually don't realize how important it is at the time they invent it. And whoever this person or person, thing, AI, government agency, whoever invented this thing, like they knew the importance of what it was from the very beginning, such that they knew it was important to basically hide their identity. And it's incredibly remarkable that they knew that up. It's like Babe Ruth calling a home run. It's just like amazing that they did that. And then it's doubly amazing that they've been able, whoever they are, they've been able to maintain the secret all this time. The way this market tends to work is there are a set of investors that the best entrepreneurs want to take money from, and then there's a lot of other investors that they don't, and that ends up being the kind of big hinge in the market.
If somebody wants to invest in venture capital, I guess they could call you up and say, I want to put money in your fund, but it's not that easy to get in your funds because funds in Silicon Valley that are well known are often oversubscribed very quickly. How does a professional investor get into one of your funds? Or how does the average person who's sitting watching this show saying, I want to invest with Andreessen Horowitz, if I can, I'll go with some other firm, but I want to be in a good venture firm. How do you know what a good venture firm is, and how do you get into one of those?
Yeah, so generally they're the ones you can't get into, and so the general rule is it's a bad idea to do this. The venture capital firms that are kind of open for outside money are generally the ones you don't want to invest in. So generally speaking, it's a bad idea. There is a platform that is worth looking at for people who want to learn more, and we are not involved in this, and this is not we're not on this. You can't invest in us through this. This is just an industry observation. There's a platform called AngelList, where basically angel investors are able to basically take money from people who want to follow their deals.
Okay.
It's worth looking at. People should go in very cautiously. This is a very speculative area, but it is a thing to explore.
Let's suppose I'm watching this and I say, I hear what you're saying, but I'm going to try to find some venture firm I'll go. It may not be Andreessen Horowitz or Sequoia, but it'll be okay. I'll try it. I'll learn. What should somebody look for in a venture fund that they're going to invest in? There's a track record, quality of the people, how much money the people in the firm are putting into the deals. What should they look for?
Yeah, so the big thing is the best entrepreneurs get to pick their investors, right? It's the reverse of how most investment markets work, right? So the best entrepreneurs get to select who invests, which venture capital firm invests. And so what you want to pay a lot of attention to is this sort of difference we described between sort of this phenomenon of adverse selection versus positive selection, right? So adverse selection is the deal that I can get into is not the one I want to be in. Right. Positive selection is basically an investor whose brand is magnetic such that the best entrepreneurs will want to be associated with that investor. And the way this market tends to work is there are a set of investors that the best entrepreneurs want to take money from, and then there's a lot of other investors that they don't, and that ends up being the kind of big hinge in the market.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that. Is that right, more or less?
Yeah, exactly right.
And then the fund just typically lasts maybe 10 years or so?
15, well these days longer, so often 15, often the tail extends out to 20 years, because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
Top-end venture is sort of 3x net of fees. Ideally, you're hoping for more than that. You're hoping for 5x or more. You're illiquid the entire time, right? So you would hope to get paid for the liquidity.
And today...
So yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Marc Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist? So
the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different, Jim Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
So let me ask you a few lightning round questions, if I could. Sure. What's the best investment advice you've ever received?
Warren Buffett, probably put all your eggs in one basket and watch that basket. Really know what you're doing. Really deeply understand the nature of what you're investing in, I think.
What's the most common investment mistake that you observe?
I think it's the opposite of that. I think it's people basically, they read about something in the paper, see it on TV, and take a flyer without deeply understanding it.
If I gave you $100,000 tomorrow, what would you do with it?
Put it in an S&P 500 index fund. Don't get fancy. And
what mistake have you made in hindsight that you wish you hadn't made in the investment world?
Oh, so this is a very interesting aspect of venture capital. For most forms of investing, the mistakes are the investments you make where you lose money, right? In our world, it's the investments you don't make. Right? Because if I make an investment in venture capital, I can make an investment, I can lose I can lose 1x, right? But if I don't make an investment and it goes up 1,000x, then I have to read about it every day for the next 30 years and think about all the money that I didn't make that I could have made. And so all of the big mistakes in my world are mistakes of commission. They're mistakes of not making the investment.
So the pleasure of being a successful venture capitalist is what? You enjoy building a company from scratch, or at least helping somebody build it. Is that the great pleasure of being a venture capitalist?
Yeah, you get to be part of the team. With basically when these things work, it's amazing, right? It's tremendous when these things really change the world. Look, the other part is the downside is you don't get to run the companies, right? You're a backseat driver, right? You don't get to you're not the person doing all the work who gets to take all the credit. The advantage is you do get to see all the new things, right? And so you do get a front row seat at this kind of amazing show of all these incredible people with all these new ideas, and that ends up being, I think, a pretty valuable part of it.